What if I told you a company stock went up by 18% during a shaky economy, and it might go up even more because of the president's flip flop? And another company that is based on luxury living, the lifestyles of the rich and famous, stock just dropped. And that tells us all we need to know about what's going on with our economy. And the darling of Wall Street, the company that we all know and love, the stock of the decade, why right now might be the greatest buying opportunity you could ever have in this company. Before we get started, though, gotta do this because my Liverpool, you will never walk alone. Champion, champion, ole, ole, ole. All my football or soccer fans, my team won the Premier League today, Liverpool. So got my scarf on because you'll never walk alone. And when it comes to investing in the stock market, helping you scale your finances, giving you investment opportunities, you will never walk alone. So like, subscribe, share it to our channel. In real life, I'm a certified financial planner, but on these social media airwaves, I'm not only a Liverpool fan, but I'm giving you information so we can grow our portfolios. Y'all ready for these opportunities? Let's go! Champions, ole, ole, ole. All right. First and foremost, the stock of the week was Rocket Money. You know Rocket. Rocket Mortgage, the #1 loan provider in the United States. They had some explosive news in a positive way last week. And guess what was that? The flip-flop of the tariffs. And Jerome Powell coming out saying, I ain't going anywhere. And inflation ticking down after the announcement of the tariffs being paused. And because of that, Rocket went up by 18%. But it has a long way to go. And these are the reasons why Rocket might be the investment of the year because of what's going ahead. What is Rocket Money? I mean, we know Rocket Mortgage, Rocket Money, same company, but what exactly? Because it's more than mortgages that they do. Well, Rocket saw a significant growth in their stock, rising over 18%, closing at over $15 a share. This surge was primarily driven by a combination of positive market sentiment that interest rates might be going down and specific company developments. And Deutsche Bank, yes, the investment firm Deutsche Bank, they actually gave Rocket a huge stock upgrade. So when the rich, more wealthy, and the elites upgrade a stock, then that is a buying signal for individuals to buy. Now the big old banks, they got a lot more money than me and you got. We put 1,000 here, 1,000 there. They're putting in 100 mil here, 100 mil there. So when this stock gets upgraded by an investment bank, you typically see a nice soar in that stock because of manipulation that happens in the stock market with these big banks. Once they buy, the price already went up. Yes, it's up by 18%, and it's going to go up a lot more. But Deutsche Bank, they know what they were doing. And they changed their analysis from hold on to the stock to actually buying the stock, citing improved fundamentals and a favorable outlook in the mortgage sector. You guys, mortgage rates are going to start going down second quarter of the year. And since the stock market is forward looking, 6 months to 12 years later, Rocket Mortgage went up. So on April 24th, their trading volume reached 11.6 million a share, surpassing the 50-day moving average. People buying it and buying it and buying it, driving that stock up because the average is 10.8 million, but it went to 11.6. So many more people was buying that stock after Deutsche Bank came out with that analysis. And also, Rocket Mortgage outperformed everybody else. Their competition, to be exact. UWL, MGIC, and Radion, who made some money, but nothing like Rocket Mortgage because, like Big Plug, the biggest, the largest. And Rocket Mortgage, from a mortgage standpoint, is the biggest, the largest. They generate more mortgages than anybody else in America. So since they are the biggest, the largest, they're going to go up more. And that's why their stock went up by 18%. Some good backing as well. You know who their CEO is? Dan Gilbert. You know, the owner of the Cavs, the one who turned Detroit. It's so hard in the D into Gilbertville and the re-gentrification of Detroit in totality has been actually based on their housing. And Dan Gilbert had a lot to do with that. Rocket Mortgage, they came from humble beginnings. You know, Rocket Mortgage is flag-based, and it's the largest retail lender in the U.S. It has created other digital platforms. And the ecosystem includes Rocket Homes, Rocket Loans, Rocket Money, and Amrock. And Rocket Companies went public in 2020 under the symbol RKT. So they're 5 years in, and they seen an increase when they first went out because of COVID, and they saw when it went down dramatically, and look where we are today. Look where we are today with Rocket Money. Their highest of high was $28 a share. A year and a half ago, they was at $21 a share. So to get back where they were a year ago, that's a 80% gain from where we are today. Getting back where they were in 2021 before it went to belly, like everything else in 2022, is over a 100% gain. My friends, Rocket Money, Rocket Companies, Dan Gilbert's company has an opportunity to go soaring because of no tariffs, prayerfully, the flip-flopping of Trump's policy, Jerome Powell staying in place and saying we're on course to do the things they talked about last year, where they was thinking about cutting rates 5 times this year. Rates have been cut already once. 4 more times this year means that people are going to buy more houses. And since Rocket Mortgage is the biggest and the baddest, this is an opportunity. We have the flip side. Even though, like Liverpool, the winner, champion, is Rocket Mortgage, we have a loser. Just like Tottenham, who lost today 5-1 against Liverpool, we have a loser. And the loser of the week, Restoration Hardware. 8. It doesn't get any more luxurious when it comes to RH. If y'all go into rooms to go, fix and stuff, you ain't seen nothing like it is RH. Luxurious showroom. Once you walk in, people there to help you, not to sell you. And the rooftop to get a little bit of lunch, get a little bit of dinner. It's amazing. Me, wife, and our daughter went there last year to get some lunch. $240 later, like what? Yeah, it's expensive. But they sell on areas. Well, with the tariffs, people are finding ways to have their dollar stretch longer. And yes, they're luxury, but they get most of their shipping from China. And more individuals are seeing that they can actually go directly to China, instead of going these third parties like RH. And because of that, and because of the CEO saying, hey, we need to cut back expectations this year and next year, their stock down by 12% when the market had an exceptional week last week. I actually saw on TikTok a person walk through the process, how they would have paid for a set of furniture that was going to be $60,000. Now that's just ridiculous. But to furnish their whole house, $60,000. But they flew to China. It cost $3,000. They went directly to the plug. They bought a shipping container, and it cost $35,000 for everything. So instead of going through a company furnishing their house for $60,000, they did a little bit of sweat equity, a little vacation, a little negotiation, bought a $12,000 container, and to come back half of the cost. When millennials get to the money, they become resourceful, and this is going to happen more. RH is going to have to either do 2 things: cut down their prices, which means lower profit margin, or lay off more people, which nobody wants to have happen. So Wall Street saw that, and that's why RH was down by 12%. And their earnings haven't even reflected that yet. Because of the softening demand in the housing market and uncertain macroeconomic environments, yes, the tariffs, excess of inventory value between 200 million and 300 million at cost is sitting there collecting dust. And the company announced delays in launching a new collection due to the tariffs. These factors contribute to the stock going down from $250 a share to $150 a share. Oh, that hurts. And do you think it's going to spike up anytime soon? I don't think so. This company, when it was created in 1979 in California, knows how to party. It was a great idea. Luxurious. You sell to the rich and famous, the lifestyles of the rich and famous. Because at first, it was actually a seller of vintage style hardware and fixtures. Over the years, it has evolved into a luxury home furniture retailer, offering a wide range of products like furniture, lighting, textures, bathware, decor. And in 2020, it rebranded from vintage to pure luxury. And there are numerous locations: the US, Canada, the UK, which is all being pinched by the tariff talk in different ways. So, if individuals are finding more expensive ways to get the same goods and services, is that a good thing or a bad thing for RH? I think it's a bad thing. If they have to lower their prices, which means lowering their profit margins, is that a good thing or a bad thing for RH? I think it's a bad thing. They are going to have to rebrand, in my opinion, and also reimagine how they make money. Because how things are now, I don't see this stock rocking and rolling anytime soon. It's down, but it might be something that you want to short. Not advice, just information. But then the biggest and largest when it comes to everything, just like my football club is the biggest revenue-wise in soccer, besides Real Madrid, but whatever. No. When it comes to England, it is, mate, with those fish and chips. We have. Now you're like, Nvidia, how is that an opportunity? Because it is the stock of the decade. Nvidia is making more money, more money, more money, more money. The CEO Jinping just went to China and had an agreement. If Trump keeps on messing up, it's a door open to do manufacturing in China. Now, of course, they don't want to do that. They're calling the president's bluff, but it's good to have friends on both sides. It must be two sides. So Nvidia is playing the game. And because they're playing the game, their stock was rewarded because the stock was going down. When it was going down, no one thought that it was going to continue to go down. But when the tide rises, all boats rise. When it's a hurricane, everything gets flushed out, and Nvidia got flushed out. That was once as high as $153 a share, went down to $83 a share. Almost a 50% decrease. Number one revenue, number one profit margin, stock of the decade. That was a humongous buying opportunity because when the tariffs came out, they got affected as well. A few weeks later, after was liberated, the stock didn't feel like that because the stock went down, and so did the stock market. But after Liberation Day, 20 days later, $80, now 111. That is a 43% gain. And to get back to 150, that's another 30% to go. This is an opportunity. The stock market averages 10% a year. Nvidia is going to make back that 30%. Will it be in a year? You tell me. I think it's going to get there. I think it's actually going to be at $200 a share in the future. When would that future be? If it's 2 years from now. It's in 2 years. End of next year, Nvidia hits $200 a share. Today it's at 111. That is a 80% gain or 40% in 2 years. Now, past performance, does not guarantee future results, and nobody knows the future but God. It's not a recommendation. But what I'm saying, Nvidia still being down by 25% from where it was a few months ago could be an opportunity of an investment life because of everything that they got going on. So what do they have going on? Positive outlook. Investment banks, including Morgan Stanley, raises revenue projections for Nvidia, reflecting strong demand in AI that's not going anywhere, and data center markets. You know, AI agents that are being created now, just like ChatGPT, Gemini, Perplexity. 3 years ago, didn't know about it. Now it's the rave. 3 years from now, AI agents will be the rave as well. In its sector altogether, it's going to help, even though it's the leader, fueled by trade tensions and optimistic earning reports. And yes, AMD, that's tanking right now, that was their biggest competitor. So that market share that's leaving AMD is going to Nvidia. And the demand for AI, for chips, for GPUs that they have a monopoly on because they do the architectural work, the building, and the selling. Uh, they do it all from chips. So since they do it all, they're getting all the profits. And since they're making all the profits, that's why it has been the stock of the decade. And I believe it still being down to where it was when it's at $153 a share is an investment opportunity, maybe of a life. And this company has so much room to grow. I mean, it's been around since 1993. It's not like it's Intel that's been around a lot longer that has done nothing. It's growing like crazy. They are the leader in chips, and AI is just getting started. So the leader is in an industry that's just getting started. Is that good or is that bad? And with the hardware, the manufacturing, and the selling of those chips, as I said, just like my Liverpool, but they are the greatest. Nvidia might be the greatest investment story over the next 10 years. So yes, it was up by 4%, but it's still down by 20% from where it was a few months ago. This is an investment opportunity, not the week, but maybe your lifetime. So what do we gotta do? We have Rocket that rocketed up 18%, but it could be up by another 80% when it's all said and done. Restoration hardware down by 12%, down by a lot more than that, and it might be a story that goes bye-bye. And the investment opportunity of a lifetime, Nvidia, being up by 4%, but still has a long way to go to get back to where it was. So, like, subscribe, share to our channel. We're here to help. I'm your friend because you will never walk alone. And from an investment standpoint, you never walk alone with me. That's why we like, subscribe, and share. As always, let's make some painful or painless purpose together, y'all. Peace.